Thoughts of the stock market conjure images of wealth, fancy suits, fast cars, lavish mansions, and images of destitution from its crashes, including the Great Depression and financial crisis. There are TV channels devoted to it, Reddit message boards that confound markets, thousands of books, magazines, and websites that write about it. But what is the stock market, and how does the stock market work? The stock market is a collection of exchanges where investors buy and sell stocks issued by publicly held companies. You might be wondering, what exactly are these stocks that are traded on the market? Stocks are an investment that represent an ownership share of a company. This entitles the stockholder, the person or institution that buys these shares of a company, to a proportion of the corporation's assets and profits equal to the amount of owned stock. Corporations issue stocks to raise funds to operate their business, including investment in research and product development and hiring. They do so through an initial public offering, or IPO. For shareholders, the stock market lets them invest their capital and, historically, earn rates of higher return than saving accounts or government bonds. Investors buy these issued shares because they believe that the company will profit or grow in the short or long term. Such growth can lead to share price appreciation and dividend payments, or profits that a corporation directly returns to shareholders. In the first case, the investor can later sell their position and pocket the difference between the sold or purchased price. In the second case, the investor continues to own shares in the company and can reinvest the received dividends to expand their holdings. There are two primary types of stock, preferred and common. Preferred shareholders do not have voting rights, but have priority over company income. Common shareholders do have voting rights, but are last in line for company assets behind bondholders, creditors, and preferred shareholders. The stock market works by offering a centralized and public place where various investors can meet to exchange shares in companies they hold or wish to hold. While some institutional investors have access to private marketplaces such as dark pools, stock exchanges are open to everyone and let individual investors place buy or sell orders on specific stocks. Investors trade stocks on these exchanges to efficiently deploy their capital. What that means exactly varies for each person. Some may believe that the next tech gadget will sweep through the country and earn its maker billions of dollars. Those investors will scoop up shares of that specific company on the expectation of future earnings. Other investors may trade a variety of stocks in a particular industry or which align with a specific factor approach. Many will take a relatively passive approach to the stock market and buy mutual funds or ETFs that largely track overall market performance, a less risky approach that generally limits commissions, time, and tax burden. The stock market, though, can be risky, regardless of your investing approach. Investors can lose money, lots of money, in the stock market. During bear markets, more investors are selling than buying stocks, pushing down overall levels and resulting in a general loss of money for those who own stocks. Investments in individual companies can also lose money if the company sees sales declines or, more dramatically, goes bankrupt, at which point its stock is essentially valueless. Conversely, when companies grow, beat expectations, and increase their profitability, investors generally make money from rising share prices. That's because demand for a given stock increases with the expectation or assumption of future earnings growth or profit that could be redistributed to shareholders. Historically, the stock market rises, but there are periods of intense market downturns that may panic investors into selling their holdings at a substantial loss, or which may challenge retired investors. That's why it's important to manage asset allocation and plan for such contingencies, knowing how you will react to market movement and not deviating from your set course of action. Overall, the stock market is a centralized way for investors to buy or sell shares that a company has offered for purchase. Its liquidity facilitates transactions in a transparent and regulated way, letting investors deploy their capital with confidence and the hope of a large financial windfall. For more information about investing, please visit www.aaii.com.